started. And good afternoon, ladies and gentlemen. Welcome to today's webinar. My name is Chen, and I'm currently working for International Department of Nanhua Futures here at Hangzhou in China. So today, we're also honored to invite Mark Sung, the electronic trading solution expert from Bloomberg, to join us. Thank you so much for coming, Mark. So in today's session, I will walk you guys through the investment process and the QFII scheme and other protocols that need to be addressed. Then Mark will introduce more on the trading side, like how investors achieve their trading goals via Bloomberg terminal and a lot of good stuff that Bloomberg could bring. If you have attended our previous series webinar, you will know that we have been promoted all this QFII business for like more than a year since the new QFII policy has been announced on September 2020. Just in case we have some new friends here today, let's recall what this policy is about. So basically, there were two things were addressed. Number one, allowing QFII to invest in onshore commodities, futures, and options, as well as private security investment fund. And number two, lowering the interest threshold for QFII. So even this policy was announced in the past whole year, we have absolutely no idea neither when this policy will take effect or what product will be involved. But things has been changed since last month because CSRC announced that the new QFII policy will be implemented starting on November 1st, 2021. In other words, technically, QFII is already able to trade onshore commodities now. Matter of fact, today is the first time for us to publicly introduce the QFII investment process after the official implementation of the policy. So I will focus more on the trading-related issue involved in the process of QFII investment in Chinese commodities futures. Okay. Let's look at some numbers first, like I always do in a presentation, as I want to come up with some, decent reasons why offshore investors should participate in Chinese futures market. If you look at the global position of China's futures derivatives trading, you will be impressed that China has actually occupied almost the half of Asian market and 1/5 of the global market. And considering China hasn't really developed its futures market until 1990s, another reason that Chinese futures market has grown so fast is China has many unique products with large trading volume. As you can see, among the top 6 products in terms of trading volume, all of those are from either agricultural or manufacturing. Which to me, I feel like it perfectly reflects China's characteristic, right? And if we look at the big picture underneath, it's not hard to see that China's total trading volume is also consistently creating new peaks. And in the point of view of global market, 3 China's commodity exchanges are also in the top 12, comparing with all the other major exchanges worldwide, especially when it comes to agricultural and metals. As you can see, Dalian Commodity Exchange and Zhengzhou Commodity Exchange are dominating the agricultural leaderboard, while the Shanghai Future Exchange and Dalian Commodity Exchange occupied the top 4 when it comes to metal. As far as energy products, China is a little bit weak, but it's still in the competition, obviously. As you can see, those names are mentioned a couple times. Okay, a little bit background about QFII itself. So QFII has been QFII scheme was established in 2002 with almost 20 years development alongside with multiple times of expanding investment scope and lowering entry threshold. China financial market is gradually open to offshore. And at the stage of today, we're submitting future account opening applications for our QFII clients, even though there is still a question mark about what product will be open to QFIIs. So let's take a look at the existing products, because we know for a fact that overseas investors and domestic traders will be using the same trading rules, just like how they did it for Chinese international contract, such as crude oil, TSR20, low sulfur fuel oil, and all that. So we can refer to this contract to see what the margin and trading rules of Chinese future product look like. For example, margin. Well, generally speaking, the exchange standard margin is usually around 10%, but exchanges will make adjustment on that if market has extremely volatility or overheated. So to me, I feel like because the structure of China's futures market is different from overseas. So the possibilities of margin adjustment happening is definitely going to be higher than, CME, LME, and all these other exchanges. Then as a futures broker, what we can do is to notify our clients the adjustment as soon as we receive the announcement from the exchange. And sharing some first-hand information with you guys. So in our conversation with multiple exchanges recently, even though they haven't made an announcement about what product will be open to QFII, but on the application they submitted to CSRC, they all applied to open all the contracts. And in another word, we believe that the final call will come soon and will cover most of the products, even if not all of them. Addition to that, these 3 domestic commodity exchanges will release announcement at the same time, announcing that QFII is good to go. Other than that, exchange also mentioned that QFII and domestic traders will be using exactly the same trading rules and limit, as well as trading hours, for example, 9 hours. Since majority of Chinese contracts has night session now, but to be clear, night session is considered as the part of the next trading day. For example, for those who's arbitraging on crude oil and WTI and Brent, they will be able to trade night session crude oil from INE and the other 2 at the same time. Okay, since this policy was announced in 2020, we have been coordinating with many hedge funds and asset management companies to help them get access to Chinese commodities. And there is one solution to achieve this goal, and that is adding a private fund layer into the process. In other words, QFII invest in a private fund in China and then trade commodities at private fund level. The reason we do this is because at the current stage, QFII can only apply for futures trading account to hedge stock index futures instead of speculation. But with this added fund layer, QFII are able to get access to Chinese commodities indirectly. However, this is definitely discouraged by regulatory, and with the rules to be announced in the future, the investment scope of the private fund that QFII invest has to comply with the investment scope of QFII. And there's another question being asked a lot, and that is, who is eligible for QFII? And the CSRC's answer to this question is, at the current stage, a QFII applicant has to be some sort of financial institution, which means that you must have some kind of financial license in your local area, and that is the current minimum requirement. But this financial license holder doesn't necessarily need to be yourself. It could be your parent company or your subsidiaries, And I know there are some energy trading center here today as well who does not have a financial license. And don't worry, in our recent conversation with CSRC, they mentioned that they didn't prohibit non-financial institution from applying QFII, okay? As long as they're trading with their own money, and they will have a possibility of successful application. To me, CSRC is also in the exploration stage on this matter. And so, the detailed rules for non-financial institution to apply for QFII will be announced in the future, I believe. Okay, if you feel like No, this is too complicated, and I'm gonna wait until final rules announced. That's totally okay. You can still participate in Chinese commodities in other ways. Currently, there are two popular methods to get access to onshore commodities. One is via international contract, and the other one is QFI. As you can see right here, if you just want to trade some of these international contracts, such as crude oil, TSR 20, and iron ore and PTA, something like that, you don't necessarily need a QFI, okay? You can just come to us or one of our overseas intermediaries to open a futures trading account and start doing your thing. So that means shorter time, lower cost, and more cash flexibility. If you're a hedge fund or asset management company who are ambitious to trade China, even you're not able to trade commodities at the moment, don't forget there are other targets that QFI is allowed to trade, such as stocks, bonds, public fund, private fund, and etc. I believe if you come to us and tell us more about what your needs and your goals, we'll definitely come up with some sort of solution for you. Okay, that should be enough as background information. And let me get to the point of today. The following slides are the most asked topic. First, how long will it take if I'm already a QFI and I want to trade with you guys? Well, the answer to that is about 7 to 8 weeks. And let's break down a little bit. First, we have pre-business communication. This is basically the time that we find out your needs and goals, determine the intention of cooperation, discuss the trading system that you want to use, the rate you want, and the settlement report format you prefer, basically just the process of knowing our client. And this is gonna take a week or two, and at the same time we can start the account opening process. So when you open a futures trading account with us, we will provide you with the filled out paperwork by using the information you gave us, if you want to give us. And all you need to do is review it, modify it, and then sign it. And considering there might be cross-border shipping involved, we will try to get this job done in 2 weeks. With the account being open, we will get started to apply future hedging or speculating access for you based on your need. And this part is more like in our end, and there's no action need as a client. Then the majority of time of this overall process is in IT preparation. In this part, we will need to know what kind of trading platform we want to use. Then we will coordinating with the corresponding software providers, and to enable you to have access to Chinese commodities via Nanhua futures on your own trading system. By the way, we have agreement with the most of the mainstream trading software providers such as Bloomberg, TT, CQG, and eSunny. So all these options are available for our clients to choose from. For those hedge funds and high frequency, prop trading groups, they might be more comfortable to use their own software, and their IT team might be strong enough to develop API to connect directly to CTP or eSunny. Our IT experts will provide corresponding API information and help you with the development process. At the same time, during IT preparation, we will discuss with our clients what type of format they prefer when it comes to settlement report. I'm sorry, I cannot display the format publicly right now due to confidential reason. But if you're interested about it, please feel free to contact me after this webinar, and we can definitely discuss more about it. Okay, after all the above steps are done, we will conduct an overall test, including deposit to trade and to settlement report, and ultimately to withdraw. So this overall process from account opening to actual trading is about 7 weeks. And in the reality, if you cooperate a while, this time will be shorter and vice versa. All right, the next topic that is most concerned is about cash transfer. For those who are not familiar with China, they always worry about fund safety and transaction efficiency. Let's talk about transaction efficiency first. The overall process is on this flow chart right here, which to me I think is very straightforward. First, you have to transfer the cash from your offshore account to your onshore custodian bank account, and you can decide whether to wire a US dollar or CNH. Then your custodian bank will do the currency exchange for you. You don't have to worry about exchange difference. I mean the rate difference between CNH and CNY and all that, because as far as I know, the custodian bank will deposit the same CNY amount into your onshore custodian account based on how much you have in CNH. If that's confused, let's take an example. Let's say you have 10 grand CNH in offshore, right? Then your custodian bank will deposit 10 grand CNY into your onshore account, okay? And as far as time cost, I know most of them can transfer your cash from offshore to onshore in the same trading day. Once your cash is transferred to onshore, and your custodian bank will send that money to our client margin account, and from there we will transfer it to the exchange. Since our client margin account and exchange special account for client margin are all protected by Chinese futures market monitoring center, so there won't be any safety risks. And of course, if you would like to subscribe a private fund in China instead, your custodian bank will transfer the money to the private fund custodian bank. What I was gonna say, oh, okay. So in this page, there is one thing I would like to point out, and that is the time period of bank future transfer. And the transfer time period is different for day session and night session, which could be a problem when it comes to margin call. Sometimes when market fluctuates a lot, margin call happens, right? If you expect to transfer money from offshore to onshore at that time, you might not be able to keep up with the margin call. So we suggest our clients to try to keep a part of cash in the account to deal with the risky incident, and also communicate with your with your QFI custodian bank, because many custodian banks will offer cash credit to their customers. And once you have successfully invested in China for a certain period of time, and decide to withdraw the money back to offshore, like, oh, okay, the money is enough, I'm done. You need to aware that for the principal part, you can transfer it back to offshore at any time. But for the profit part, if you have any, you will need to conduct an audit report on that portion before you can withdraw it. Usually there is a one-time cost from accounting firm who's responsible for editing, and that cost is like around 30 to 40 grand RMB a year, which is about like 5,000 US dollar. If you don't have any profit in China during your investment, then there is no audit needed. Other than that, you also need to know the tax solution for QFI. We know for a fact that QFI is exempt from value-added taxes, but there is a certain possibility that it will apply to a 10% capital investment tax, since this is the very first time that offshore could participate in Chinese commodities. So there has no relevant regulations yet. And our suggestion is to leave 10% in your to leave 10% of your profit in the custodian bank account for tax purpose until further policy comes out. All right, moving to the next slide. Let's talk about risk control in Chinese futures market. If the position that was bought on a margin drops in price, the account may be under margin, right? And in China, there's a term risk rate, which was calculated by which is calculated as position margin divided by total account funds, and which is also the benchmark we use to assess our client's risky level. Once this number is over 80%, we will send an early warning, just to remind you, hey, your account is under margin call risk. You need to be more cautious. If the market still goes to another way and the risk rate going up and over 100%, we will conduct a margin call, notifying you that you're under margin in your account and you must either deposit more cash or close some of the positions to offset all or part of the difference between the actual price and the margin. But don't worry, we're gonna give you at least 24 hours to deal with it and to react. And if the risk rate is still over 100% on the on 230 on next trading day on T+1 day, we will have the right to execute the forced liquidation. That's fair enough, right? There actually is an example underneath. Let's say your margin was sufficient on T-1 day, but the risk rate exceed 100% due to the price fluctuation on T day, on the trading day. We will need to call you during the trading day to remind you that you could either add money or close positions at 2:30 on that trading day or certain agreed time. If you don't take any actions and the risk rate is still over 100% on T+1 day, we will have the right to execute forced liquidation and reduce your risk rate to below 100%. I believe this is very straightforward. But how are we gonna notify you, and what other notifications we could deliver? Let's look at this big form right here. Other than risk rate notification, we will also monitor your position limit, your trading limit, as well as other exchange notice that may affect your trading experience. In Chinese futures market, there are trading limits and position limit, like I said, on certain products. For example, iron ore at Dalian Commodity Exchange. The trading limit, I believe, is 1,000 lots, which means you're not allowed to open more than 1,000 lots per order. And there is also position limit exists. Like for January month, the maximum position you can have is 40,000 lots. But when it comes to delivery months, the position limit drops to 2,000 lots. And if you trade against these policies, the exchange will send a warning and have the right to execute forced liquidation or restrict you from position opening. And this kind of punishment is also applied to the situation if you violate against other rules, such as abnormal transaction behavior. So that is our responsibility to remind our clients in time and prevent this kind of situation from happening. And all these notifications, as well as settlement report and exchange notice we delivered, we go through email, we go and phone calls, SMS, or other method that we both agreed. So you don't need to worry about violations as long as we communicate smoothly, right? As for the next part, we're going to talk about IT related matters, including trading platform and co-location services. So currently we have agreement, like I said, with Bloomberg, TT, CQG, and eSunny, and all of which have access to Chinese commodities. You'll be able to trade whatever product is open under this new QFII policy through all above 4 platforms. And I'm gonna let Mark share more about it, as he's being a veteran in this industry, and I believe he has a lot of good stuff to share with you guys. And for those who has strong demand on speed, we can also provide solutions even from 1,000 miles away. In this slide, you're able to see that we have 4 different server rooms in different locations, to cover all 4 exchanges in mainland China. Even our server room is not in the exchange, but they're definitely as close as they can be. And matter of fact, our low latency, no doubt, is definitely in the first tier domestically. And on the interface level for trading, we can provide NHTD, which is developed by ourselves, as well as YD server, REM, and mini eSunny. And for the market interface, we have NHMD and REM for our clients to choose from. Okay, so that's basically everything about trading related subject today. And now let's recall a little bit. Under this new QFII policy, other than engage to actual trading, QFII quota holders are also allowed to invest in private fund, right? For example, CTA product. CTA refers to Commodity Trading Advisor. It is a form of fund in which professional managers aim to pursue absolute returns, use funds entrusted by customers to invest in futures market and option market, and charge corresponding investment fees. So for many QFII applicants we have dealt with, they have very enormous asset scale, such as sovereign fund, pension fund, and even some certain investment banks. Their main focus might not be chasing an 80% annual return. Instead, they have strong confidence in China financial market and look forward to get a steady investment return with lower risk. Then CTA product should definitely be included in this discussion. On the left-hand side, this is a Barclay CTA index comparing with Standard Poor's 500. You can see every time when the stock market experience crisis or significantly retracement, CTA index shows steady upward trend and low correlation with stocks. And the interesting is this situation also happens in China, even though Chinese CTA market didn't really develop until 2011. You can see no matter how the stock market, the blue line and the green the orange line are represent for stocks. So no matter how the stock market fluctuates, the CTA index always maintain a low correlation upward trend. Is there going to be a retracement in CTA? Probably, but should CTA considered as steady instrument? Most definitely. Then we have sorted out some of the most popular CTA products in the Chinese futures market and divided them in different ways. And this is what end up with. Based on strategy, there are trend, arbitrage, quantitative hedging, and machine learning. In the year of 2020, with the great bull market in Chinese commodities, many CTA with trend strategy ended up with like over 80, over 100% annual return. So the majority of CTA products in the market now are trend strategy. But based on our observation, I believe many of them are having a really hard time this year. Instead, the performance of mixed multi-strategies is doing even better. Anyway, that's how we classify CTA based on strategy. There are also categories such as data source, target, and trading frequency for reference. And on the next slide, I share some alternative targets operated by us, which are available for QFII quota holder to choose from. From top to bottom, there is a Nanhua commodity index developed by our institute, which is recognized as an authoritative Chinese commodity industry index, and also 2 CTA products that we're running right now. So Nanhua CTA number 1 has been operating for 3 years. That's the middle one, with cumulative profit of over 100% and an annual return of 27%. And Nanhua CTA trend number 1 has also been operating for almost for more than 2 years, with a cumulative profit of 48% and an annually of 21%. If you would like to discuss more about CTA strategies or these products instead, you're also more than welcome to reach out to me individually after today's session. Okay, a little bit information of who we are before I hand it over to Mark. So Nanhua Futures is the first A-share-listed futures company with subsidiaries in Hong Kong, Chicago, London, and Singapore, as well as 41 branches in China. We're managing more than 12 billion RMB in public fund, 5 billion RMB in asset management product, and also 200 million US dollar in offshore. Okay, that's pretty much everything I want to share with you guys today. And don't forget to follow us on LinkedIn and YouTube, where we post our research reports, industry news, and past webinars. If you are interested in anything I have mentioned today or have any questions, please also feel free to reach me at nhoverseas@nanhua.com or my personal email underneath. Okay, I hope you guys enjoyed my introduction. Then I believe Mark will share the trading solution that Bloomberg could bring. And I'll hand it over to you, Mark, if you're ready. And I'm gonna stop the screen sharing and mute.
Thank you, Xiaoyu. Thank you. And thank you, Nanhua Futures, for inviting us to participate in this webinar. This is Mark from Bloomberg, covering e-trading solutions in China. Bloomberg actually has been in China for over 25 years, providing localized support across all terminal and enterprise products for our clients. So in terms of trading, we provide multi-asset and broker-neutral trading solutions for clients trading to China across all asset classes, including listed equities, futures, options, as well as OTC derivatives. So our execution platforms can help optimize workflow by consolidating Bloomberg data, news, and analytics into a single workplace. For example, for trading listed products like futures, we have an execution management platform called EMSX. EMSX is actually a multi-asset trading platform that integrates all the broker connections into one single platform. And our trading solutions cover the full trading cycle from pre-trade to at-trade, and also to post-trade analysis. So whatever your trading workflow, we have direct trading connectivity solutions, and also infrastructure support to help you to access to onshore market here in China. Actually, for the past few years, we have seen a rapid rise of local and international hedge funds in trading into China. So from technology perspective, the implementation of successful trading strategies will not be complete without effective market connectivity. And access to low latency market data and direct market access has become very important nowadays. So for offshore international funds, we have not only seen trading activities increased, but also an increasing number of global managers raising onshore capital through like UFI and PFM structures, but keep leveraging their global trading infrastructure at the same time. So in terms of future trading, we have already deployed a local server here in Shanghai. Our trading platform clients can utilize our local server to reduce latency, and all the orders will be processed in our local data center in Shanghai as well. As shown in this chat here, the placement are sent to Nanhua through our local network, and then to the local exchanges. So all the execution reports will be processed in China as well. We also have set up direct fixed connection with most of the onshore OMS used by onshore brokers like CTP, RootNet, FS, Hang Seng, etc. In terms of trading platform, our platform EMSX, as I just mentioned before, allows our clients to seamlessly route single orders or basket orders to multiple brokers at the same time. It also supports speedy order intake, fast broker, and algo selection. We also provide 24 hours global support. And we do have a futures trading platform that's specially designed for futures trading. It allows to trade simple or complex futures and options strategies, as well as algo strategies in global futures exchanges. And our futures trading platform offers pre-trade risk settings. It can control the pre-trade risk limits at different levels, like user level, group level, or even at the firm level. For price deviation, we use waterfall logic. That means if the price is to be used to evaluate against is not available, then the calculation continues by using the next price field set by the broker. Once the pre-trade limit is set up, we can proceed to trading. Here, this is a snapshot of our escalator screenshots. This actually enables trader to quickly identify market trends and profit from a single window that customized for your own trading style. Our client can actually monitor market price on top left, and then key in quick orders on top right here. Then you can also set up your own spread metrics at the bottom left, and then place orders on the chart on the bottom right at the same time. The escalator I just showed you here actually can enable traders to quickly identify market sentiment based on color. So for example, the price bar here, it will show blue if market is going up, and then it will show red if market is going south. And traders can also directly place, revise, or cancel orders on this escalator as well. In terms of algos are also available on our futures trading platform. One of the commonly used algos for single orders is entry and exit conditions. There are 3 entry and exit conditions which can be used, including time trigger, target, and also economic release. So for time trigger, you can activate or cancel an order at a specific time. And for target, the second one, target, you can activate or cancel an order when the price or volume target is met. Actually, these 2 conditions, time trigger and target, they can be used together. For example, activate the order at 9:30 in the morning and waiting for the ask size to be greater than like 200 or 300 lots. For the third one, economic release, the trigger is actually based on the economic report release. For example, you can use these fundamental report numbers as a trigger, and then place order on our platform as well. Another popular algo is synthetic spread. It actually allows you to create a customized spread and trade directly. So you can actually create your own customized spread and decide how the spread is quoted here, and then how the spread is executed from our futures trading platform. For execution, for example, the show box here that used to indicate which leg should be displayed on the order book. And the trader can actually specify the maximum size of the slice that is displayed. And the if leg setting control, it controls how the algorithm reacts to scenarios where it is lagged. This is when the show lag is executed. This is when the show lag is executed, but the other leg did not fill and is currently still on the order book. So to try to unlag this trade, our algos will go through a two-step process to try to fill this spread without a lagging scenario. Here are some other examples of the algos we support. So for synthetic orders, we support like pegging, stop limit, and as well as iceberg. And for strategies like if then, OCO, one cancel another, and for schedule-based algos like TWAP, VWAP, go along. And then for we also support volume participation algos like go along here. I will not actually go through each one in details today, but if you're interested, we're happy to do a follow-up demo after this webinar. So in terms of trading workflow we actually support multiple workflows. You can actually leverage Bloomberg Terminal and route orders directly from our execution platforms like EMSX, like TradeBooks, to onshore brokers. At the same time, if you need to leverage your own trading system for like compliance or risk check purpose, we have many clients actually already adopted our fixed model, so they can leverage our local server for routing, at the same time keep integrating with their own global system. So for example, if you have your own OMS, but want to leverage Bloomberg's execution platform as front end, so we can also support staging workflow here. So that means clients can actually fix stage into our platform from their OMS, or upload from Excel to generate both orders and also placements out to onshore brokers like Nanhua. And then all the trade reports, all the trading status will be reflected back to your OMS in real time. And apart from staging, we also offer connectivity solutions. So if you prefer to send orders directly from your own OMS or EMS, you can also leverage our local broker network. The connectivity is fully hosted within China. That means all the orders will be processed in China through our local fixed server as well. So for a quick wrap, our integrated platform gives our clients the ability to leverage a host of powerful solutions that covers the trading lifecycle, from pre-trade analytics to broker execution. And our local server here can help you to reduce latency as well. So please let us know if you're interested for the demo. You can actually scan this QR code here for feedback. We are happy to do the follow-up based on your request after this webinar. Yeah, that's all for my introduction for trading part. Thank you very much for your time today. Thank you.
Thank you, Mark, for this great demonstration. And as one of the top 5 or top 3 trading terminals, I guess Bloomberg definitely has some unique advantages. And guys, if you have any questions regarding Mark's session, please feel free to reach out to him or us, and we will get the answer back to you as soon as possible. Okay, guys, that's basically everything we have today. I appreciate all your time and thank you so much for attending. And Mark, thank you a lot for joining us today. Thank you again. I wish every single one of you are having a blessed day, and we're gonna conduct more webinars discussing all the matters that we have been mentioned today. Once we have further notice from the exchange and CSRC regarding the QFII status. Okay, I'll see you guys next time. Goodbye.